I thought first of all, when I was in your shoes, I've learned a lot over compensation over the years, a lot of surprises that I didn't expect when I joined my first startup. And we're hoping today to go through a bunch of content. When I tried to put some content together, I was lucky enough to get two of the folks that I think know the most of my network in compensation to join. And I think it'd be great if you guys could just tell a little bit about your backgrounds.
Sure. Right. I can go first. Hi, I'm Tim Wenzel, and I'm currently VP of HR at a startup called TalkBox in San Francisco. Prior to that, I was VP of HR for Tesla Motors, the electric car company. And then prior to that, I was director of staffing at PayPal. So I joined as the first recruiter there back in 2000 and sort of grew the staffing organization as the company scaled. And when SAR reached out to me about this, I thought, I'd love to come talk, but I'm really more of a recruiter than a compensation expert. I'm fascinated by the whole art and science of compensation, but I was a little bit intimidated to come as an expert. So Marlo is probably the most brilliant comp person that I knew, so I thought he could come and actually deliver some content that was more valuable than I could bring. But I'm happy to be here.
Yeah, I'm Marlo Rondoni, Eni, but that's a common mistake in my name. I've been getting that a lot. And I most recently was the VP of HR at Santra Corporation. I've left. I'm about to join a clinical research company. Kind of a return to my misspent youth in actuarial science, of all things, and computer science. In terms of my background in education. Santra is one of many companies that are really struggling in the downturn, so we had to quickly move production to China and try to live on our cash, because the IPO market, in case you hadn't noticed, is not good. Is that fair? But by way of compensation, I actually worked with the Radford organization. If any of you have heard of them, they sort of have the premier benchmark salary survey for high tech, and all the companies you could ever think of are members of that. So that's kind of where the compensation experience came from, and then also the real life experience. And being a VP of HR, I've also been through a couple of startups during the internet boom. First one made a lot of money and sold ourselves to a competitor, and then we lost it all in the next one because we thought we were smart and not lucky. So that's a little bit about me. So
great. So just we put together a quick deck. I'm hoping it'll take us about 30 minutes to get through it. If you have burning questions, feel free to raise your hand during the panel. We'd love to address your question. Otherwise, let's try and save it to the end, because we're going to try and cover a lot, including these things here. To keep some focus to the conversation, though, we're going to try and focus this conversation to compensation and accepting an offer in a venture-backed startup. If you guys are interested in being a founder, figuring out founder compensation, partnerships, other things, we can potentially set up another time to do that or answer your questions at the end. But with that, I thought we'd start today with just some really basic questions that I know I had when I graduated from the GSB, and we'll sort of run this in a panel-type format. So I guess, Tim and Marlo, if it's my first job coming out of a corporation or the GSB, should I expect a big pay cut to join a venture-backed startup?
So the short answer is it depends. I would say, generally speaking, it's less common than I think a lot of people think to have to take a significant pay cut. I'd say on base pay, it's generally, you're going to find that decently funded startups are going to be competitive on base pay relative to large corporations or sort of non-technology type companies. Where you're going to see the difference, I think, is that most venture-backed companies don't offer a bonus plan. So you're generally trading some cash in the form of a bonus for upside on the equity. So the times where I've seen people have to take a base pay cut is generally when they're working for a big company and happen to be more toward 75th percentile on cash, or if they're coming out of an investment bank or the venture capital world, then the comp model is different in those organizations. So you might see a decent pay cut if you're sort of killing it on the cash. But in the corporate technology world, there's not going to be generally a significant pay cut. I don't know if you want to.
Yeah, no, that fits. I did 2 comp studies for my board at Santur, and we were sitting at the 50th percentile, and this was across large and small companies. So we were finding that an engineer or certain roles at a mid-level startup was very similar to even large companies that we were competing for talent for. So yeah, on base pay, usually right in there, and you're definitely going to be giving up stuff on incentive compensation and other cash. So
Great.
And benefits generally are a little less generous in most venture-backed startups.
So next question. When you get an offer, sometimes these offers can be pretty scary. You have language like "at will," and people don't always react well to that. What should folks expect to see in an offer from a startup?
yeah, well, first off, at will, my labor attorney wouldn't want me to say this, but it's not. They can't just fire you for any reason whatsoever. So somebody walks in and says you're out of here, you're at will. There's still rules to follow. So protect yourselves in that regard. But generally, the letter is going to be a combination of a couple of things. It's clearly going to state usually your title. Nice to know what that is, and your direct report, clearly your compensation, and your eligibility for other benefits. There'll be general stuff about your stock option, your grant. Usually, that's the grant itself is not approved till the next board meeting, but you'll have the basic information there. And then there'll be a number of things again about at will. You're usually signing up for a mandatory arbitration in the event of any conflict. If any of you are not U.S. citizens, there'll be stipulations in there that you need to be approved to work in the U.S. If there's visa issues, you need to state those kind of things right up front so that they can handle the management of the transfer of your visa or even help you with H-1B, find out if they'll pay for it, or if you leave within a certain amount of time, whether they will charge you for the 10 grand it's going to take to get you properly visaed. And then there's also the famous some form of a proprietary information and inventions agreement. That's not really a non-compete, but it's really just talking about drawing the boundaries around the intellectual property that's going to be owned by the company versus yours. And so if you have prior inventions and things of that nature, that's the vehicle through which you want to disclose all that so that you're not giving up something that really is yours, but also defining the boundaries of what belongs to the company that you're going to join. Anything else? Okay.
No, that's basically it.
That's great.
Okay.
So I started my career in investment banking where folks are very focused on their annual bonus, as I'm sure you guys know. In startups, do people get bonuses? Who gets bonuses? What should people expect?
So I found that, as I said earlier, in at least pre-revenue, pre-profit, venture-backed startups, bonuses are going to be pretty rare. Usually you kind of try to establish milestones at the exec team level in terms of when it makes sense to move the comp in that direction. And generally the model is as you approach IPO or after you're public, there tends to be a little less upside on the equity. So that tends to be a good time. And if your business is doing well, that usually is roughly in the same ballpark as the time where your revenue is starting to grow and hopefully you're on a nice track toward profitability. So like at PayPal, for example, we had no bonus until eBay bought us, basically. And then we sort of slowly adopted their bonus program. So I think it's generally not a good idea to offer bonuses when you're not profitable because you want everyone, everyone's going to be shareholders. You want everyone to kind of have the same sort of motivation. And as everyone tries to get toward profitability, and then once you hit that milestone, then I think it makes sense to start implementing some sort of bonus structure. But I mean, that may be oversimplifying the issue because obviously every business is different. But
yeah, I think that works for a lot of roles. For those of you guys thinking of going into sales, they're all bonuses.
Different beast.
Right?
Yeah, and most of the sales incentive plans that I've seen lately are usually up to an additional 50% of pay. Is really not unusual. So, but you tend not to see bonuses really in two categories. I do see them a lot for a VP level and above. I also, especially for more mature startups, will also see some various forms of development incentive plans where there'll be an R&D team tasked with certain things. And but generally speaking, yeah, not going to see a lot of annual bonuses. It is common practice for an annual salary focal or at anniversary performance reviews. Merit budgets have been kind of in the 3 to 4% range. The overall budget, now obviously some people get 0 and some people get 20. But there's generally some commitment to that practice. You're going to see a lot of variance in how well they do it. Most startups are just really suck at this stuff in terms of just management in general. So you'll be walking into a lot of companies that they just don't think about those things. They don't think about organization. They don't think about the problems of performance, even though you have really brilliant people in the room. So you're going to see a lot of bad management, and so you'll have to find the grace and the mettle to deal with those circumstances and try to help your organization thrive no matter what. So
That's great. So,
And
So
I'm sorry, one more
Yeah,
point
go
on the options practices. I'd say they do vary widely, again, depending on how mature the management of the company is. But I'd say it is, it's usually my recommendation to couple the annual performance review process with at least a look at both base pay and a refresh grant opportunity. And then you try and make those based on performance. So your top performers, you should, in my opinion, constantly be refreshing their stock on an annual basis. And then some companies end up doing it twice a year. Some companies don't do it at all. And then they realize, wait a minute, this top performer is sort of about to vest out of their new hire grant. Let's rush and try and make it up. But I like to try and make it an annual review process across the whole company. That way you can compare your entire, you can sort of rack stank your performers and then sort of make sure you're taking care of your top performers first.
great. So this is one of the probably most common questions everyone has is, you have an offer, is it a good offer? How much should you expect to get paid coming out of the GSB? We're going to address this again later in the presentation as well and give you some resources where you can find some really granular data. But at a high level, if you're a newly minted MBA, what are you going to get paid?
So I'm just going to throw out a ballpark. I haven't actually hired newly minted MBAs for the last year, so my data points may be slightly outdated, but 85 to 125, sort of a wide range, but that's sort of what I saw the last time I was sort of recruiting right out of MBA programs.
Yeah, and to maybe cut it a little bit, depending upon what you would qualify for by virtue of your prior experience and all that. More often than not, companies have very acceptable leveling, and so the big buckets are like senior manager, director, usually a couple of levels of director, and then VP level. So when you're kind of looking at those, comp ranges, you're looking at senior manager level, kind of in the 90 to 100 range. Directors are probably in the 110 up to 150 for director 2 levels, and then VP level is sort of 140 to 190. And you're going to see more of that in, especially in more mature startups. And so those are kind of the general, the general guidelines. And some of that is going to be a function of, again, prior experience and what you bring to the table. Just being an MBA, certainly from Stanford, is a non-trivial benefit. But a lot of the high-tech startups are going to, it'll be interesting as you discover how they view you and, take notes and, sell yourself in the right way to secure, over the best compensation you can get. They actually don't know a lot of the time. What did you used to make? And then there becomes this jockeying exercise of, what else they want to pay you. So you're going to be interviewed by people that are probably as ill-informed as you might be in some levels. I don't mean to denigrate anyone at various startups, but they're often just really not experienced. And so when I was approving offers, it was pretty hysterical what they would propose and why. And I usually had to kind of bring them back to what practice was and what the company's compensation goals were. So just keep a good sense of humor about it. So.
I think it's probably obvious to many of you that you're not going to get rich off salaries at startups, at venture-backed startups. So what we thought we would do is just spend a few minutes going through some basics in options. And we'll go through some details, and then we'll get into some math of how you should think about an option offer and how you actually get rich with options. Marla, do you want to take us through the quiz?
This is just kind of a checkpoint because I don't know in the room who's had experience with options before or not. So kind of a quick little quiz to kind of jog your own thoughts about, gee, I need to know that or I don't know that. So I'm not going to get really detailed, but I'm just going to click through a few questions and give the answers. And hopefully it'll be a help for areas that you may need to study as you kind of look into your next career move. So, how do I go forward?
Just hit the
Forward button.
left area.
Okay. An option's in the money if it's vested and therefore exercisable. Its price is less than the stock's market value, or the price is greater than the stock's market value. Anybody want to throw out an answer? A, B, or C? B. Okay. Room says B. Okay, good. Yeah, in the money when the price is less than the stock's market value. So, unfortunately, right now, sorry, I don't know if you've done the math yet, but my gut tells me that anybody that got a grant in the last 2 years or more is underwater right now. So in some respects, if you go to work for a company that's already public, you're probably going to get some basement prices on stock. So there might be some real benefits there. But yeah, in the money is good, but that's not what's going on right now. Non-qualified stock options, you'll get this sort of issue of NSOs versus ISOs, incentive stock options. But taxes are triggered when the options are granted, when the options are exercised, when the stock is sold, or both B and C. Anybody want to swag that one? Yeah, it's B and C. So if you are in an NSO situation, usually that's a value point. You're going to be granted ISOs, but if the value below 100,000, then it becomes an NSO, and therefore the tax rules change. But generally, you pay ordinary income tax on the spread. And again, as you're going to learn all this if you haven't. But I learned all this when I first actually received a grant for the first time and had to read the option plan and all that. And so you're going to be able to teach this yourself just by virtue of being a recipient of this type of comp. So stock options themselves, A, allow you to buy a certain number of shares at a preset price within a time frame, require you to buy a certain number of shares at a preset price, or prohibit you from buying any stock in your employer except a certain time. Yeah. Preset price. So you get the actual grant, the number of shares, and the strike or exercise price. And usually you're going to see plans that have a 10-year expiration. They're immediately exercisable, whether they're vested or not. And that's pretty typical now. There's not a lot of variance nowadays in these plans. So with incentive stock options, taxes are triggered when the options are granted, when the options are exercised, when the stock is sold. Sorry, it depends. Anyway, typically it depends. So depending on how you've actually done the exercise. So again, if you have stock options, you may have a decision to make. When do I exercise? Do I early X? Do I wait? And so it's just a reminder that's going to be one of the issues, that there are tax implications. So at my company, Santor, when I exercised on a grant, I had to cough up $75,000 for the shares, and then I got a tax bill on the spread. And so, I mean, not a pretty big deal. And so when you make that exercise, make sure you know what you're getting into. So,
yeah, I think also just in our discussion, Marlo had a great point when we were preparing for this, that most companies are just going to tell you to refer to your tax advisor around these issues. The companies are not set out to be helpful to you guys in figuring out how to manage your options. And so you really should. There are different tax implications here. You should absolutely spend the time and talk to your tax consultant.
Yeah. Okay. Which stock options can be granted at discounts to their market price? Non-qualified, incentive stock options, or both? That's a discount. And it's ISOs are greater or equal to the stock's market value. NSOs are the ones that can be granted at a discount. And again, depending upon where you're at in the company and the types of grants that you're going to get, there are implications for NSOs. They also have the transferability, which can be nice in certain situations. Okay. Tim can answer this one for us. Is prudent to exercise your options early?
No.
There we go. Sorry, I went too fast. But anyway, This 10% rule I mean, when I was early in my career, I didn't care if I had 50 or even 75% in stock, but overall, the real issue is part of your own portfolio management and what other assets you have. I think at your stage, I still am overly, invested in certain things, and because I'm kind of stupid that way. But and with regard to the stock itself, how do you feel about the company? Are the prospects good or bad?
And what's your own sort of risk tolerance?
Yeah.
I don't mind. I actually kind of like gambling, so I might be a little bit more willing to have a larger percentage of my total portfolio vested in my company's stock. It's probably not the smartest thing in the world, so it's more risk. You could get more hurt, or you could get richer. So you kind of think about what your risk tolerance is, and then in addition to that, how much confidence do you have in your company's prospects, and then make a decision. Go ahead.
Are we assuming that there's a market value for this stock? Are you talking about post-IPO or?
I think this applies to both private and publicly traded companies. Obviously, with a public company, you know what the value is, so you have more information, and it's liquid, so it's a little bit different. But I would say that if it's a private company and you have, like, let's say the strike price is relatively high, and you have to actually shell out a fair amount of cash to invest in the company's stock, and it's not liquid, and maybe your base pay isn't huge and there's no bonus. All of those things lend itself to having more skin in the game. Versus a publicly traded company, you can sell. I'd suggest if you are at a publicly traded company, you have stock options. I'm a fan of selling at regular intervals. So once there is an exit, I wouldn't personally suggest that you hold on to the stock too long. I had a lot of friends that did that at PayPal and sort of got smoked by it because the stock took a pretty big dive, like around 2005, I think. So I mean. There's sort of a ton of information that we could go on and on about here, but I don't know if that answers your question. Is there another question over here?
Yeah, can we maybe, you might be taking this in this direction later, but can we talk more about the judgment part of it as opposed to the mechanics part of it? So maybe the mechanics you can look up in Google, right? But just judgment of what are the things that you consider when you join a startup? Do you ever work for free for a startup that you really believe in? Do you consider, if you don't have the money yet, they're about to get funded or something like that?
I think we're going to try and do that in the end, because we're going to try and focus this really on compensation, not judgment of how do you pick a startup. I think that's probably just a very different conversation. Well, we'd love to address it, but let's do it later.
Yeah, so just to kind of wrap up the stock really quickly, those are some of the issues that you'll be facing if you're going to have stock options. So bottom line, you're probably going to get ISOs when you join a startup. Boards are normally setting the guidelines for what you can get, so there's some variability there, but there's not a ton of variability. Usually immediately exercisable, vests over 4 years. First year is a cliff, so 0% first year, you're 25% vested monthly thereafter. And then we already talked about follow-on grants. And the big thing, speaking of judgment, is the valuation of these things is really tricky because you're basically going to be told what the amount of shares are, what percentage of outstanding it is, and the strike price, and not a lot else. And you can use all kinds of models on the web to figure out what they might be worth, and it's very theoretical. So you are, in fact, making a decision about what you feel about the prospects of the company. So, and yes, please.
Ask your management what the valuation of the company is in this latest round, so maybe you can get an idea of it.
Yeah, what was the last strike? What's the current valuation? So.
Will they tell you?
Yep. If they don't, I've got a problem with that. Good question. Yeah.
So just few more quick questions. For those of you that will be disappointed with your initial option grant, the obvious question is, can you get more?
Yeah, so I touched on this a little bit earlier. The answer is it varies widely. I would suggest that if you join a company, you're there for over a year, and you feel like you're performing at a really sort of high level, I'd ask the question if there's not a mature performance management process in place where you actually sit down and are reviewed by your manager. A lot of managers aren't good at making it a priority, so you may have to make sure they have their one-on-ones and make sure you're having career discussions with your manager. Ask for feedback if they're not giving it to you. If the feedback's positive, don't be afraid to say, hey, can we talk about what it takes to get another refresh grant? Question?
What percentage on asking that before you accept an offer, so to be reviewed in X period for more options?
So asking what the process is for, or what the opportunities might look like in the future for refresh grants? Is that the question?
Kind of pre-negotiating that opportunity to have that considered.
That's generally going to be a policy of the company. And you might get an answer in an unstructured environment that says, yeah, we can talk about that. Or the other extreme is, yes, it happens on June 1st every year, company-wide, and we do a performance review and we have ranges. It tends to sort of, when you get bigger, they tend to hire HR people that have done this stuff before, and then you start seeing it. In the less structured, so in those companies, it's not as much of an issue because it's not something that's really going to be pre-negotiable because it's going to be based on performance. If it's early stage and sort of Wild West, small company, it's good to ask the question and then have follow-on discussions as you're going through your time with the company.
So it doesn't impact your view of the candidate when they ask that sort of question?
No, they're actually really good questions. I'd be astonished at what people don't ask. And so I kind of tease them a little bit and say, don't you want to know this? So one caution here is if you're going to work for a later stage startup, a lot of these companies, Santor was hoping to do an IPO in 2007 and decided to defer it, and then the IPO market kind of petered out. Well, they were expecting, a payday. And they actually were running out of stock. And many mature startups, how many shares are even eligible to grant. Now, I guess good news, bad news is they've been tons of layoffs, so they've probably gotten a lot of shares back. But for mature startups, you want to ask a few more of those questions about valuation and their plans, and also how many shares are available for grant. Because I have seen a lot of, again, companies that were expecting to go public, they're now 5 years, 6 years, 7 years into it, and they're running out of shares, which means if they're going to grant more, there's more dilution. While you wait for the exit market to get better. So,
great. Well, let's just do this one quickly. I think it is a surprise for some folks that they have to buy shares, right?
Right.
What happens when you leave? If you get fired?
So if you've hit usually there's a 1-year cliff on your option. So if you haven't hit your 1 year and you did early exercise, you just get your check, you get your money back. So companies generally have a 90-day window to exercise their right to buy back, and in almost every scenario that I've seen, the company actually does that because they'd be effectively giving you 4 years worth of stock otherwise. The only scenario where that might happen would be where if the company's going through bankruptcy or about to fold, and they just don't have cash to do it, but I'd say that's pretty rare.
Yeah, but bottom line is you can exercise on your vested shares and keep them. So that's usually the plan. And again, if you early exercise, any unvested shares will be bought back by the company, and you get a check for it.
Yeah, I think the one surprise that I've seen time and time again is folks who have a decent size option grant, and then they leave a company and they have 30 days in some cases, 90 days in others to write a pretty big check if they haven't exercised already, and then they're going through this exercise to decide what to do, and it can be quite painful.
Question over here.
Yeah.
You mentioned something about the company buying back shares. So the question number 2 is whether you need money to actually exercise the options, which I understand happens when you decide to exercise or leave, not when you join the company.
Right. When you get the grant, you're not writing a check. You get it.
So I don't understand what the company buys back because don't the uninvested options just return to the employee board?
So there's something called an 83B election, which is the right to exercise your shares early. So even though you haven't vested them, most companies offer you the right to buy all 4 years worth of your shares up front, and there's some tax benefits to doing that. So that's what it relates to, is buying back the unvested shares.
Yeah. So if you exercise on 10,000 and you're only halfway through, they're going to buy back 5,000.
So in the offer letter, what are the key questions you need to ask to evaluate an option grant?
How many shares are there outstanding? It's really about percentage of the company. So the actual number of shares doesn't really matter because if the company has 1 billion shares outstanding and they're offering you 100,000 shares, 100,000 sounds like a pretty good number, but if you do the math, it's actually not. And you should be aware that, if you don't already know this, that as companies get closer to the IPO, they look at how many shares are outstanding, what their target IPO price is going to be, and then they'll adjust the number of shares outstanding based on that. So at PayPal, for example, we did a 4-for-1 reverse split, So if you had 100,000 shares at new hire, all of a sudden you had 25,000 shares before the IPO. And some employees freaked out. They said, wait a minute, the company's stealing from me, when that's not actually true. It's just division, and so changing. So again, just the percentage of the company is the main thing to think about.
Great. So we thought we'd just give you one quick example of how you actually get rich with options. These are the basics. You're going to get a grant of some number of shares, in this case 50,000 options with an exercise price of 10 cents. You're going to find out how many shares are fully outstanding, which is going to give you an ownership number. And you have to make some assumption around how your ownership will get diluted over time. And that can be related to private financings or a public financing. And then you need an assumption around the exit. I think the interesting thing here is there's very few things here that are in your control. The exit number, the dilution over time, et cetera, really are not things you can control. You can just build a sensitivity model to do that. But ultimately, you want to know, how do you make lots of money? And it really comes down to the final exit value, either at an IPO or a sale. So I think what's interesting here is if you look on a pretty small grant, at $1 billion exit, the gross proceeds would be about $3.8 million in this example. If you just want to put that in context, Google, which is probably the best venture investment in history, at its peak was trading at a $250 billion market cap. So you can run the math for what some of your friends who are early employees at Google might be worth. And I think the other real issue here is, you're going to hear this, I think, from a lot of your professors. In startup land, it's much more important that you pick the right company than picking a company as you go through evaluating which startup to join. And especially in this environment, historically, I think when we look at the data at Charles River Ventures, there's really only been a handful of billion-dollar exits every year, which, to go back, is that $3.8 million payout for a newly minted MBA. And if you exclude the dot-com days and then you think about the current environment, you can get pretty depressed pretty quickly about what your chances are of seeing a huge payout from options. If we look today at from an IPO visibility window, I'd say no one has visibility into when the IPO window is going to come back. From an M&A perspective, stocks are depressed from acquirers. There's not a lot of companies sitting on tons of cash. And so, if you ask me for my perspective, I think it's much more likely we'll see exits in the $100 million to $500 million range or even smaller over the next few years if you were looking for a payout based on your equity sometime soon. But that being said, we're still believers that there are a handful of companies every year that are huge outcomes. And, Marlo had a great point, which was, I think, prior to the boom, there were a handful of companies in Silicon Valley that created a lot of the wealth out of options for folks. I think the boom was a bit of an anomaly, and my guess is we're going to move back to that type of distribution of payouts, at least over the next foreseeable future. So I'd encourage you to really think hard about the company you pick, which can be frustrating when you really are focused on the role you want to play. And unfortunately, I guess one mantra that I often use is it's actually sometimes more important to have the wrong role at the right company than the right role at the wrong company. There are thousands and thousands of venture-backed startups in Silicon Valley, and just a handful are going to get to that billion-dollar exit. But with that, I guess I'm curious if anyone is hiring, and I'm glad to say that Tim's actually here at the Stanford Job Fair, so he has some perspective of at least one company that's hiring. But if you're an MBA, are any startups hiring? What can folks expect to see in this environment?
Yeah, obviously the activity is much softer than it was a year ago, to say the least. But I'm finding that it's actually still a relatively competitive market. Now, personally, I'm really focused on hiring engineers right now, but I am still running into multiple offer situations for sort of the cream of the crop engineers. I've talked to some of my friends who are in MBA programs, and I'm finding that there are still opportunities. You just have to think about it a little bit differently. To Sar's point, think more about how interesting the business is and how annoying or not the people are that you'll be working with, and because you're going to spend so much time with them over the next couple of years. So it's the reality is the $1 billion plus exits it's a very small percentage of the outcomes. So I would encourage you to try and stay optimistic, but I think if you definitely work on your network, ask your smartest friends what they're doing. I'm sure you guys all know this stuff, but I found that most people that are really well networked actually don't have to apply. Once you have some experience, you don't have to spend a lot of time on job boards and things like that. And as Stanford MBAs, I know you guys are big on networking, so that's usually the best way to identify opportunities, especially in the venture world, because a lot of jobs aren't necessarily even advertised.
That's great. So if you do get one of these jobs, since we have the benefit, since you guys have hired so many people, what's fair game? Is anything negotiable in this environment? Do you have any leverage as a recent MBA?
So I wouldn't say that everything is negotiable, in my opinion, and I think on the details, Marlo and I think we agree on most of the stuff, but some of the things that we don't necessarily see eye to eye on, for example, time off. Like I might not suggest that you ask to negotiate your paid time off package in most cases, unless if it's a really early stage company and they don't know what they're doing. But if you're offered something reasonable like 3 weeks vacation, in most cases I wouldn't suggest negotiating that. The things to think about negotiating would be base pay and options in the venture world. And I'd say try and be reasonable and open when you're negotiating. Some of the things that are my personal sort of hot buttons are when a candidate doesn't want to tell me what they've been earning, or if they're not willing to, at least at a high level, talk about the other companies they're talking to. I like it to be an open discussion, and then I can explain to them how we look at compensation, sort of looking at internal comparisons, looking at the market data, and coming up with something that's reasonable. And then I'd say try to negotiate. In my opinion, is negotiate once and try and get to a reasonable place. Candidates that try and negotiate 2 and 3 times, it tends to start burning through some political capital, and it can kind of set your job off on the wrong foot in my experience.
Looking at the bottom half of your slide, the health and welfare benefits, the 401k, is any of that stuff negotiable? I thought that's sort of set at a corporate level, and you're not going to have anything different than
right
next year.
Yeah, so the benefits package, in my experience, I've never really negotiated on things like 401k or medical plans. That's all sort of standard based on company policy. I don't know. Have you seen something different?
Not there. My difference on the time off, for example, is I used to offer, if I was getting squeezed on compensation because I'm hitting my budget for a position, I would actually offer an additional week. So normally, if you come in new to a company, I think it's really dumb. But for some reason, time off is based on years of service, which as a professional, that makes no sense to me. And I've been losing that argument for years. Maybe I'll win one day. It just is really daft. And people that are real professionals, regardless of vacation, they work and they do the job. And so it's just irritating to me that they have these schedules based on service. So I would regularly offer people that are really wanted, I would put them at the tier. So rather than, usually it's like 0 to 3 years, 3 weeks, 4 to 6 years, 4 weeks, I would just kind of bump them up a tier and give them an additional week's vacation and as sort of an inducement. And then I've also been asked, and I was very happy to have that conversation with people, especially that I really wanted to get on board. But yeah, on health and welfare and all that, 401k, there's not a lot of matches. I actually think for an early stage company, it's a poor investment, even though I think it's an amazing employee benefit that I usually encourage and put in place once the company can afford it. Health and welfare benefits they're generally good. They're a lot richer than you might think. There are not many bare bones packages, especially once the company gets going. And usually contributions are actually pretty low. The last survey I did, they were actually quite a bit lower than more mature companies that we looked at. So, but it's something worth asking, by the way, when you're in an offer, is like how much out of pocket, because you want to think of your total pay, and a lot of these out of pocket things can actually change what the total pay package is if you're having a cough up, like especially if you have a family, $1,000 a month for family coverage, something like that. So
That's great. So we're running, I think, 4 minutes over, but this is our last prepared slide, and then we'll open up the open up for Q&A. I think the interesting thing that's happened really, at least in my view, in the past 3 years with social media and people contributing data to the web is what's happened in the salary space specifically. And there's a few companies that I just wanted to refer to you guys. You know, the ranges that we put out there of the 80 to 120K, we actually checked across a whole bunch of companies. But if you wanted to know, you know, what does a product manager at Google make or at Facebook, or there's a number of companies out there that have some of this data. It's company specific within the startup world, which really was hard to get at before, short of going to a Radford or finding access to a database. But you can also get reviews and other really interesting inside information that employees have posted. Now it's user generated, so in many cases they may be lying, but you can take that, you know, for what it's worth. And then I'd encourage you guys to really talk to the CES and CMC if you have more questions around this. They've got just a great network and have seen a lot of things over the years. So,
Can you talk about standard ranges for salary? Can you talk about standard ranges or how to think about the ranges for options?
Depends obviously on the role, but I've found so I'm in sort of the post B round, 25 employees. For most of our roles that would require an MBA, we're probably looking at anywhere from 0.25% of the company to 1%. The 1% would be probably for someone more senior than a newly minted MBA, probably be someone 5 years out. But I don't know if that gives you a wide range. And then as you get to a more mature late stage startup, the percentages are obviously going to go down because you're getting a smaller piece of a more valuable pie.
Can you talk a little bit about some of the motivating techniques for cutting attrition among employees and sort of motivating perhaps more of a transient workforce than maybe we're thinking about 5-year periods?
Yeah, that's an interesting question and something that sparks a lot of debate amongst the HR community and leaders everywhere. My experience is it comes down to the leadership of the company and the culture that you're creating. That's the number one sort of thing that can help with attrition. I'm a little less focused on sort of over-the-top, benefits and, like we do free food at TalkBox, but I don't think most people are deciding to join the company because of that. But when you start getting crazy with, haircuts and on-site dental and all that stuff, I think it's fine if you're at a point where you have so much cash you can offer some of that. But I think in the last few years we've seen some companies take that a little too far, in my opinion. I mean, a lot of people that I've talked to that I've either hired or tried to recruit out of Google, for example, you gain 15 pounds on the free food the first 3 months. That's kind of common knowledge, and I'd rather, not. I don't need to put on any more weight.
So in terms of the options, you negotiate your offer. You ask about the shares outstanding and the strike price and so on. My experience has been through this with a startup. A lot of that's like, okay, it's verbal, it's in discussion, and a lot of that gets put down in paper. And then, okay, so your options are you have to go to the board, and it'll be approved by the board at point X, in the future. I'm feeling a bit insecure about when all that's going to happen, what is going to get written down in paper if we have a strike price, and then if you leave when you have some options vested, that you want to exercise those and the company will buy them back, what price do they pay for those, if they're going to buy them back? And so
I'd encourage you not to get too worried about when your options will be actually approved, unless you're dealing with someone that you don't trust. I mean, I think usually you have a certain level of trust. Yeah, but generally your options will be approved at the next board meeting. Most companies do monthly board meetings, so it usually happens within 30 days of your start date. But you're still a year away from hitting your cliff anyway, and it's a longer term thing. So you don't necessarily need to rush into exercising your options or getting your stock paperwork, unless you think there's something shady going on at the company, in which case you probably shouldn't.
Yeah. Yeah, you get an option agreement. Yeah. It's signed, board approved. You're in the board minutes when the grant is actually made. The buyback situation, they can't buy back them all. If you look at most equity plans, I haven't seen one otherwise. If you have unvested shares that you had purchased in an early exercise and they're not vested, they're not yours. The company buys them back. They're not buying back the shares that
they're
are
not
vested
buying back the vested shares, right?
Yeah. Mm-hmm. So there's for some senior executives, they're getting really big blocks. Like some star CEO that was granted 5%. There'll be all kinds of restrictions and repurchase rights and right of first refusal and all that, because you don't want to have 10 million shares of something not really working for the company at some point. So but that's a different scenario. Sure, same time.
Okay.
No, go ahead.
For first years, could you touch very, very briefly on summer internship sort of salary ranges, and if there's any chance of options granted for the summer if you choose to work there after graduation, or just sort of the summer experience, I guess?
Yeah, so my experience hiring interns is, and again, it's sort of all over the map depending on the maturity of the company. But at PayPal, before we were public, we offered fairly small comp package, and it was strictly cash at the time. So if I recall correctly, it was probably somewhere prorated $60K-ish, annualized. And then after the acquisition by eBay, we tended to be a little bit more sort of trying to be aligned with what you might actually see out of your second year in a full-time role. So, 80 to 90K annualized. I don't think I've ever seen a situation where you're actually getting equity as an intern. Have you seen that at all?
No. I mean, at least in the state of California, there's I don't think you can even do an unpaid internship anymore because of the way the labor wage and hour laws work. So, I mean, the good news is if people are doing internships, they're paying, just because the not paying somebody is just a nightmare in this state now. But yeah, I've never really seen option grants to interns at this stage.
Yeah, for the refresh grants, how much of the original value is investment? Is the range 50%, or 70%?
So you're trying to relate the refresh grant range to the new hire range? So I've seen typically 25 to 50% of the new hire range is common if it's an annual refresh. Does that sound about right?
Yeah.
I think also just given the exit environment, if you assume that the company's likely not going to exit in 4 years, for key employees, they're also adding more equity every year so that at the end of 4 years, people don't just walk.
Just wondering what's the average or general range of compensations with regard to having like the split of salary versus options? It says like 10 or 20% would your total compensation would be an option. So is there some general guidelines to how that's split?
They're not for a private company. They're not really linked. You'll tend not to see them linked. So there'll be your base pay. Again, generally it's coming in at 50th percentile. It tends to be reasonably competitive with even non-startup pay, unless we're talking really early stage where you might be working for nothing for a while, very little. And the options are really a function of the rules that we talked about. They're based upon sort of levels, and then subsequent ones based upon performance. It could be, we do re-ups a lot before IPO to kind of fix the mistakes, in terms of who owns what when we do an IPO. With public companies, you will get, especially at executive levels, sort of director and above, you start to see they want a certain amount of shares outstanding as a multiple of pay. And that's where you see this link. So at certain executive positions, they're going to be granting, based upon certain value, 2x pay every year. You get into 3, 4, and 5x pay for certain executives, but that's kind of how that's when it does in fact get related to compensation.
You'll also, in negotiating an offer, find folks often trade off salary for more equity, correct? Or they'll propose that to you at least.
Yeah, I mean, I think, again, in earlier stage companies, you'll probably more commonly find companies who are willing to give you sort of a sliding scale. I used to do that my first couple of years at PayPal. I'd kind of give candidates 3 different packages to choose from depending on their risk tolerance. And I might have given them maybe a 10K spread on cash with corresponding option grants that are sort of tiered, so lower cash, higher equity, or vice versa. And then as you get more mature, it's harder to do that. After the eBay acquisition, you couldn't be quite as creative.
Yeah. In this market, though, I would have candidates ask me, how much cash do we have? Can we pay the salary? People actually negotiating more for cash than equity. People don't want equity right now. It's kind of like just pay me. So I got that a lot over the last year.
Great.
Just to clarify, so if an employer is getting fired and some options vested, some didn't vest, the company doesn't buy back the vested shares.
Right.
The company buys back unvested shares. For what price?
For the strike price, so for what you pay.
For what?
So if your strike price was 10 cents, you're going to get 10 cents a share back. So there's not going to be a difference. Does that make sense? Because you actually haven't earned those shares yet, so it's just sort of reconciling back those shares to the company.
I'm asking from the perspective of an entrepreneur.
Of what? Of the entrepreneur?
Yeah.
Yeah, so if you're the entrepreneur, you're the employer, and someone works for you for a year, you fire them. Let's say they had 100,000 shares over 4 years. You get to buy back 75,000 shares. So it's 75,000 shares times the strike price. If it's 10 cents, you just do the math.
If they've exercised.
If they've exercised, right. If they haven't exercised, it's not an issue because there hasn't been any cash.
If I don't fire this person, the company reaches the exit. So this strike price of 75, let's say, of 10 cents, this is actually the strike price of the option. So they have the full exit for their shares.
Say that one more time.
They sell their vested shares at almost market price. Is this correct?
When you say sell, so you're talking about
at exit.
At exit, yeah, that's right. If it's a public company, you sell at the market price. If it's an acquisition, the market price is negotiated within the deal.
Let me maybe try and answer it a little differently. I'm not sure I fully understand the question, but you have a concept of acceleration in, let's say, an exit. So if I've only vested, let's say, a year, 25% of the 100,000 shares, and then there's an M&A or an IPO, there may be in my offer letter or in the option grant some language around acceleration around an exit.
So in the case of change in control, you may see a 25% acceleration. We had that at PayPal. So if you were 1 year vested, deal happens, all of a sudden you'd be 50% vested overnight. I believe, Milo, correct me if I'm wrong, I think that sort of practice is becoming less common, at least from the people I've talked to. I haven't seen as many.
The VCs, they're
real
real sweethearts, but they don't like it. They don't like the double triggers and accelerated vest, and you tend to only see it at certain executive positions. I have not seen a broad, change of control type of accelerated vest for all people. So,
great. I'm going to take one last question, and then we'll just be around afterwards for those of you guys that want to keep talking.
RSUs as opposed to options
Good
and
question.
startup compensation?
So it's shifted in the last couple of years. I've seen, especially in mature companies, instead of base pay plus bonus plus options, now the most common practice is base pay plus bonus plus a lower amount of options and RSUs. So I think the logic behind that is that when the stock goes down, you at least have some value that you're accruing over time with RSUs versus
Can you just explain
options.
what RSUs?
RSUs is a restricted stock. Basically, instead of an option, which is a right to purchase, an RSU is the company's actually giving you shares. So it'll be a much lower number of shares because there's no strike price, you're not shelling out cash. So it's a little bit less risky for you, less upside. But yeah, that's a good question. Something we didn't really cover here is that is shifting. RSUs are becoming much more common practice, especially in public companies.
Yeah, and some of that stuff to protect against repricings were always hated by institutional shareholders, but accepted at some level by boards and all that because things were going up. But there's that practice, not a lot of appetite for it. So I've been sort of designing around that fact, and as a way to deliver value to employees consistently over a period of time, and using those design strategies to help just manage the total comp package and remove some of the slings and arrows of things we can't control in the market. So.
And I just wanted to quickly try to address your question earlier about how to pick a company that's going to be. 30 seconds. I don't know if there's anyone that's an expert in that. I mean, you can talk to venture capitalists that have, that spend their time, that are experts doing this, and they still have mixed results. When YouTube first started, I personally didn't see the potential there. I actually tried to talk Steve Chen out of not leaving PayPal to go work full-time at YouTube. So I don't know if there's, I think you have to kind of trust your gut, your intuition, do your analysis of the market, et cetera. But I don't know. I don't know if you agree.
We can talk about it more afterwards, too.
Talk to SAR if you're
But,
trying to evaluate a business. Maybe.
These guys are super busy, so if you guys could just give me a hand.